Let's go to Clive McDonald, Head of Equity Strategy with Standard Chartered Bank, joins us from Singapore. Clive, good morning. Thank you for joining us. Asian equities got a breather when Fed decided to delay tapering. Do you expect volatility will return soon, or we will only see volatility once Fed decides to actually implement tapering in 2014?
Well, the Standard Chartered view is that tapering by the Fed is likely to begin in March 2014. And as such, we see a window of opportunity for equity markets, particularly in South and Southeast Asia, to recapture some of their underperformance from July and August. So we'd say that we are reasonably constructive through year end on Asian equities, particularly South and Southeast Asia.
Clive, hi, morning. So if indeed it's March before we actually see tapering, how would you play Asian equities? And can we see a risk-on rally up until then?
Well, our preference for Asian equities is definitely South and Southeast Asia over the next 3 months relative to North Asia. We see those markets, particularly the likes of Indonesia, India, benefiting from a short-term relief rally, certainly helped by a return of liquidity from international markets back towards the emerging world. But we do see it only as a window of opportunity, because fundamentally tapering is postponed, not cancelled, and hence there will be a divergence between our shorter-term outlook, preferring South and Southeast Asia, relative to our longer-term outlook, where actually that would reverse and we prefer North Asia.
Clive, it's almost given that Janet Yellen will succeed Bernanke. Are markets already, or have markets already discounted that news?
I think initially the markets were certainly very excited after Summers withdrew his nomination. And while the smart money seems to be on Janet Yellen as taking over from Bernanke, other names have been thrown in the ring as well, particularly Timothy Geithner, as seen as one potential outside candidate. Certainly would be a very credible one. Unfortunately, though, he said he does not want the job. So clearly Obama has a bit of persuading to do. But if Yellen indeed does get the position, she is seen as very, very dovish. That could signal that the exit from tapering could be slower than expected, which would be good news for liquidity flows to Asia.
Right, so though recovery is visible in the US, Europe, but growth in most Asian economies is pretty slackening. Could this mean further downgrades?
Certainly there are risks to earnings at the moment. The Standard Chartered forecast for China, for example, sees GDP slowing from 7.5% this year to 7.2% next year. And in turn, we expect EPS growth to slow from 15% this year to 10% next year. So there are some risks surrounding the outlook for earnings. But I think we need to keep in mind that the market's a discounting mechanism and has already discounted a significant portion of the deceleration in earnings growth. The question from here is how much further is the downside risk to earnings, and in turn that would give you a signal for the outlook for the market.
Clive, India and Indonesia, which face the threat of fund reversal, both have gone ahead with rate hikes. Do you think this is the right strategy, or eventually this will have an impact on economic growth?
We have recently altered our view on India with regard to RBI policy. Previously, we expected a 25 basis points cut in the first quarter of next year, but now we've reversed that and we look for a further series of interest rate hikes by the RBI as they belatedly play catch-up to try and tackle inflation. And the same phenomenon in Indonesia, Bank Indonesia raising rates in order to tackle inflation. The challenge is that the belated efforts to tackle inflation are going to throttle economic growth at the same time that portfolio inflows are slackening off. So these countries very much face a significant headwind looking further out into 2014. And we would contrast that with the approach of Turkey, which initially followed the same policy, raising rates to tackle inflation, support the currency, but recently capitulated, has allowed the currency to try and find its own level, and they're using monetary policy to try and be more supportive of growth, at the price, obviously, of inflation.
So, Clive, which sectors would you advise investors to stick to when it comes to India, and which ones to avoid?
The sectors that we prefer in India center on software services. We're also quite constructed towards the healthcare sector as well as telecoms. They'd be the main ones that would be overweight. The underweight sectors in India would center on the banks, specifically the state-owned banks, as well as some of the infrastructure plays.
What about Indian currency? Do you think Indian currency now has stabilized and all the current account deficit concerns are passe for Indian economy, and the Indian government has done enough to turn the CAD around?
Yes, we're already seeing the trade accounts improve, and I think that will filter through to the current account position with a lag. And recently we've actually become more constructive on the outlook for the Indian rupee. Previously we were forecasting a value of 62 against the dollar by year end, but now we've raised that, looking for 69.50. So we think that the policy moves by the RBI are credible for both inflation and the currency, but as I mentioned, that's at the cost of growth. Growth will be slower than expected.
So do you see the danger of reforms taking a backseat as India goes to election?
Certainly there is a risk that as we head towards the elections at the latest April next year, that the reform agenda does take a backseat and the government goes for more populist policies and postpones some of the tough decisions, and that could weigh on market sentiment. And from a valuation point of view, I think India is still in the expensive zone, but not as expensive as what it was back in the second quarter of this year. Valuations have come down quite a bit, but relative to other markets in the region, China, Korea, Taiwan, India does look more expensive.